In terms of a calculated speculation, it's the best I've seen in 34, almost 35 years in finance. I've never seen something that silver offers something called asymmetrical risk reward. The best I've ever seen, which means it has, in my mind, the lowest downside risk and the best upside potential of anything I've ever seen. In an asset that is depleting in nature and massively being accumulated by most of the world in quantities that we've never seen before. So problem here is that the price setting mechanism, the exchanges of the West mask and blur and confuse reality. And so it's hard for people to know just how good of a deal this really is, but it truly is a special, I think, a special opportunity if pulled off right.
Andy Schectman, CEO of Miles Franklin and a seasoned expert with 30 years in the precious metals industry, offers compelling insights into the current gold and silver markets. Schectman's enthusiasm for the current gold-to-silver ratio is based on historical precedent. In 2010, when this ratio hit 85-1 for only the second time in recorded history, it presented a significant opportunity. Investors who traded 1 ounce of gold for 85 ounces of silver saw their investment double in just 7 months as the ratio adjusted to 37-1, with silver reaching $50 and gold $1,915. Today we find ourselves in a similar situation. The gold-to-silver ratio currently stands at around 90, indicating that gold is relatively expensive compared to silver. While this ratio is notably high, it remains below the all-time peak of about 120, reached during the 2020 coronavirus lockdowns, suggesting potential room for adjustment. Historically, silver has tended to outperform gold during periods of strong economic growth and industrial expansion, while lagging during economic stress. This cyclical pattern offers valuable insight for investors, considering the current market conditions. Drawing on his nearly 35 years in finance, Schectman believes that silver presents the best asymmetrical risk-reward opportunity he has ever encountered. He emphasizes its minimal downside risk and exceptional upside potential. Recent market movements support Schectman's analysis that silver has corrected after reaching a high of $30.19 on August 26. This correction could provide an entry point for investors with a long-term outlook. Additionally, the Silver Institute projects a 17% increase in the global silver deficit to 215.3 million troy ounces by 2024, driven by a 2% growth in demand and a 1% decline in total supply. Please tune in for our exploration of Andy Schectman's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
I've been buying gold too, because in the end, I think gold is the place to be. Here again, we have to time this properly. Silver is by far the investment of a generation. And I don't say that lightly. There's nothing like it. And that chart should really hammer that home. These banks that are shorting this metal, not only are they sophisticated, they're informed and probably being told to do it by the West, the military industrial complex, or whoever is stupid enough to tell them to short silver to that degree, naked short in what amounts to a drive to accumulate by the biggest powers in the world. It's a very dangerous game. 85-1 is an anomaly historically, geologically. It's 11 times higher than just about than it's coming out of the ground at. It's contrived. It's enough to make China go all around the world or all through Latin America and buy unrefined silver concentrate and doré. They are beating us at our own game. Look at the drawdown in the LBMA vaults, the lowest they've had since they started keeping records. So yeah, I mean, in a perfect world, you buy silver or trade gold to silver at 85-1, and when it gets anywhere into the 40s, you switch back. And even at 42-1, which is just above its 200-year average, you're still 6-7 times higher than it's coming out of the ground at. I mean, it's one of these deals where the potential is extraordinary due to the suppression. And you know, the old saying, the market can stay irrational longer than you can stay solvent. And that's been the case for a while. But in 2010, when I noticed this and called Bix Weir and said, Bix, we got to do a podcast, got to tell everyone to sell their gold right now. It was 85-1. I said, Bix, this is the second time I'm going back as far as I can see, all the way back in charts. And it's the second time it's ever happened. And so in theory, in 2010, you trade me 1 ounce of gold and get back 85 ounces of silver, of course, depending upon the form. 7 months later, knowing that 42 to 45-1 is the 200-year price average, not the geologic, but the price. Man's ratio, as Bill Holter calls it, not God's ratio, which is geologic. And within 7 months, you had 37 to 1. You had $50 silver, 1915 gold. In 7 months, you would have only needed 37 ounces to get back that 1 ounce of gold. You would have doubled plus what you started with. And it worked. It was orderly, it was smooth, it was clean. But would it be this time? What are the variables? What is Murphy lurking around the corner, just to revenge, and is gold all of a sudden disappear? Or I don't know. So in theory, yes, it is the trade of my career. I mean, I could see that being the trade. And I've had some really good ones, playing the Swiss franc when they decided to not join the European Union. That was a good one. And there have been some other really good ones, but every one of the biggest trades I've ever done in my career center around exploitation, first identification of price anomalies. This is a price anomaly. And so, yeah, from a standpoint of actual numbers, yeah, it makes great sense. Big Square would scream at you, yes, do it. So I just like people to understand that nothing is a guarantee. But in terms of a calculated speculation, it's the best I've seen in 34, almost 35 years in finance. I've never seen something that silver offers something called asymmetrical risk reward. The best I've ever seen, which means it has, in my mind, the lowest downside risk and the best upside potential of anything I've ever seen. In an asset that is depleting in nature and massively being accumulated by most of the world in quantities that we've never seen before. So, problem here is that the price setting mechanism, the exchanges of the West mask and blur and confuse reality. And so it's hard for people to know just how good of a deal this really is, but it truly is I think, a special opportunity if pulled off right.
AndySchectman provides valuable insights into current gold market trends. He reflects on 2008, when gold prices fell from $1,000 to $700 and silver from $21 to $9, arguing that these declines were not due to a lack of demand or global dumping. Today, gold prices are declining, influenced by a stronger U.S. dollar as investors await crucial U.S. inflation data that could signal the Federal Reserve's potential interest rate cut in September. Spot gold is down 0.8% at $2,505.03 per ounce, dropping as much as 1.1% earlier. U.S. gold futures ended 0.6% lower at $2,537.80. Schectman challenges the explanation that gold prices drop during stock market corrections due to traders seeking liquidity, suggesting that market manipulation might be a factor. Let's get back to the interview.
Over the last 3-4 years, this is a situation where silver and gold are far more valuable than the currencies that purchase it. Much of the world understands this. We don't. And to try and play games and try and bottom feed and get lucky, it's not something that I think will go over very well, especially with such a small participation of the U.S. public. If gold and silver are doing what they have been doing, let's forget about silver because it's been held down. But look at gold, and silver will surpass gold in percentage terms, I believe, before it's all said and done. But if gold is doing what it's doing with positive real yield, forget about the nonsense out of the BLS and all that stuff, but a positive real yield is strong dollar and waning participation by the West. What happens when that changes? What happens now that we're pivoting and we're going to lower rates and we're going to weaken the dollar and we're going to reignite inflation? And does the public wake up to this and start buying? It's rocket fuel. But much of what we see in the metals market is illusionary, unfortunately, because it's the antithesis of the system that has been allowed to rise unabated versus gold and silver, which have been stepped on. And although they continue to move, I would argue stepped on to the point where they have not been allowed to fully express themselves to their real potential. Even gold, which has outpaced the S&P 500, and doubled the performance of the 10-year treasury. Gold's 9.9% per year. It's up 20% this year. It's whatever it may be. When we think the price of gold should be flying, quite often the folks in charge will sell short on the exchanges and drive the price down. Now, every time that happens in the middle of or in the midst of a market correction, stock market correction, that is attributed to traders rushing to liquidity, throwing out the baby with the bathwater, trying to grab their most liquid asset and use it to pay off margin debt or whatnot. I don't know that I believe it. I think it's an attempt, I believe, of the powers that be to mitigate the outcome of the correction. It's to mitigate the thrust and the drive, not only to accumulate gold, but to delink the rationale that people would employ for owning it. Oh, it's an archaic relic of the past. It's a barbarous relic. It's not inversely correlated. See, the market collapses and look what happens. And even if I'm wrong, even if it truly is a rush to liquidity and the price falls, if we go back to 2008, that's a great example. And we've talked a lot about this, you and I, over the years. But in 2008, when the market collapsed, we saw immediately the price of gold and silver get clobbered. And gold fell from 1,000 to 700 and silver from 21 to 9. And one would think in an environment where the price of asset A and B fell by 30 and 60% respectively, that there's no demand for that, that it's being dumped globally and the price is just cascading down. But that really wasn't the case, because in 2008, every single mint across the globe was shut down. Ultimately, the US mint was shut down 7 or 8 times that year and really was the model of inefficiency, much more so than they were the last 3 or 4 years.
The gold and stock markets are poised for significant changes as key factors evolve. Gold prices recently dropped to a 2-week low, and the stock market, indicating potential upheaval, are areas of keen investor focus. Gold may continue fluctuating due to ongoing profit-taking, while the stock market could face increased volatility amid warnings of a potential major downturn. As these trends unfold, both markets will likely experience continued uncertainty and substantial movements. How will upcoming economic developments impact gold and the stock market? Share your predictions and insights in the comments below. If you found this analysis helpful, don't forget to like, subscribe, and hit the bell icon for the latest updates. Thanks for watching.